Third quarter of 2025 was a pivot point for fixed income markets, with a handful of key developments steering the story for income investors. Labor markets lose momentum, central banks shift back to cutting interest rates, bond markets respond positively, and Matco's Diversified Income Fund delivered steady results. Now, after holding policy steady through the spring and summer, the Bank of Canada cut its overnight rate by 25 basis points in September, bringing it down to 2.5%. This move came in response to a weakening labor market and sluggish exports, with policymakers signaling a willingness to cut further if economic risks intensify. Canadian yields responded by moving lower, particularly in the short and medium-term segments of the yield curve. In the US, the Federal Reserve also cut rates by 25 basis points in September. This was the first cut since December of 2024, lowering the federal funds target to 4.25%. The Fed's decision reflected rising risks in the labor market, with slowing job growth and higher unemployment offsetting resilient GDP numbers and corporate profitability. Markets now expect one, maybe two additional cuts before year-end, provided that inflation holds steady and the labor market continues to soften to an extent. Across both countries, bond markets responded positively. In the US, Treasury yields rallied, especially again in that shorter part of the 2 to 5 year maturities, supporting fixed income gains. Credit markets also held up well, with investment grade and high yield spreads tightening modestly. This reflects stable corporate profit fundamentals, ongoing demand for yield. In Canada, the picture was more mixed. Long government bonds underperformed, but shorter duration and corporate bonds fared better, allowing thoughtfully positioned portfolios to capture gains both from falling rates and positive yield carry. The Diversified Income Fund, anchored in medium duration exposure and a disciplined mix of government and high-quality corporate bonds, was well positioned to benefit through it all. Credit selection remains a central focus, emphasizing issuers with resilient cash flows, conservative balance sheets, and limited exposure to trade and commodity volatility. Our allocation to the CMLS mortgage investment continued to enhance yield while reinforcing the fund's overall stability. Just to recap key positioning highlights: medium duration bonds positioned to capture and benefit from renewed rate cuts, emphasis on investment grade corporate credit, avoiding higher risk segments, balanced exposure to federal and provincial bonds for added stability, and a continued allocation to mortgage investments for that enhancement of income. Now, we've covered some decent ground, so let's briefly recap. Labor markets lost momentum, central banks eased, bonds rallied, specifically short and midterm rates fell while credit spreads held firm, and income delivered. Matco's Diversified Income Fund benefited from its medium duration, quality credit, and 4.3% annual distribution yield. Notably, cash drag is resurfacing as a problem for investors, with GIC rates and money market yields continuing to decline alongside central bank rate cuts. As a result, the yield advantage of a well-constructed diversified income portfolio is widening, offering investors a more attractive income opportunities than short-term cash instruments. When it comes to equities, corporate profits continue to demonstrate resilient growth. However, the earnings yield of the S&P 500 now sits on par with the yield of US 10-year treasuries. Historically, this type of comparison suggests that income investments may offer more compelling risk-adjusted value relative to equities. Now, as we move into the final quarter of 2025, fixed income markets are once again offering a compelling mix of yield stability and added downside protection. For central banks carefully easing, equity volatility still elevated and credit fundamentals intact, the Diversified Income Fund remains well positioned to weather late cycle uncertainty, capture income, and deliver strong risk-adjusted returns.